In this session, let us understand what is bills of exchange through a simple example. Okay, let's say there are two parties, one Mr. A and the other party is Mr. B. Now, Mr. A is selling goods to Mr. B. Let's say the value of goods sold is something like 10,000 rupees. Fine. And Mr. A demands the payment immediately. But Mr. B says he is not in a position to make the payment immediately. He need at least 3 months time. So Mr. A does not want to miss out this sale. Okay, so he is ready to give 3 months time period, but he wants some security. Okay, because what is the guarantee that after 3 months Mr. B will make the payment? So Mr. A says that he will prepare a document, and in the document Mr. B should sign. Okay, and Mr. B agrees for that because Mr. B is in need of the goods worth 10,000, but he is not in a position to pay now, and Mr. A is ready to sell on 3 months credit period. So Mr. B had agreed to sign on any document which Mr. A produces. Okay, so Mr. A prepared a document, and in the document he mentioned that Mr. B should pay to the order of Mr. A rupees 10,000. Okay, 3 months from the date of bill. So let's say the date of bill is something like that. Let's say date of bill is 1st April. So 3 months from the date of bill means, so 1st April, 1st May is 1 month, 1st June, 2nd month, and 1st July. Okay, it means it is payable on 1st July. So Mr. A prepares this document and he sends it to Mr. B. Mr. B receives this document and Mr. B is accepting this document, and how he is communicating his acceptance? He affixes a revenue stamp and he signs across. He is signing across the revenue stamp, and he says that he is accepting. That is, on the face of the document, let's say this is the document. Okay, on the face of the document he says accepted. So now this document becomes a legal document. This document becomes a legal document. It means on the due date, here the due date is 1st July. On due date, Mr. B has an obligation. Mr. B has an obligation to make payment to A, and the amount is 10,000. And as a proof, there is a document which is prepared by Mr. A and accepted by B. Okay, and it becomes a legal document which can be produced in court of law in case if Mr. B fails to honor. Okay, so on 1st July, Mr. B is bound to honor this document and make the payment. Fine. When Mr. B makes the payment, what will happen? Mr. A will return this document to B. So what is the name of this document? Okay, the name of this document is nothing but bills of exchange. So here Mr. A, instead of receiving the cash, he is going to receive a bill from Mr. B, which of course he prepared and Mr. B accepted. So he is selling goods worth 10,000. Goods are going from A to B, and Mr. B is giving him bill of exchange. Okay, bill of exchange instead of cash now. And exactly on due date, Mr. A will give the bill of exchange to Mr. B, and Mr. B will give cash to A. Okay, so this is how it operates, and this document basically gives a guarantee, a security for Mr. A. Fine. So this is about bills of exchange, and why we use the term exchange. I mean, it can also be transferred. Okay, number one. Number two, it can also be presented with a bank, and money can be availed even earlier. What does that mean? Let's say Mr. A has sold the goods on 1st April, and Mr. B is going to make the payment only on 1st July, because he had given the guarantee document, right? He signed the bills of exchange. But Mr. A is in need of money. So what Mr. A will do? Mr. A will approach his banker. Mr. A will go to his banker, and he will show, or he will inform his banker, look, I have sold goods to Mr. B worth 10,000, and he has agreed to make the payment on 1st July. So exactly after 3 months I'll be getting the money, but I'm in need of money. So you keep this bill as security. Keep this bill of exchange as security, okay, and give me money or give me loan. Banker generally accept these kind of transactions, and the banker will give loan, okay, and when the banker gives loan against this bill of exchange, what they'll do, they'll collect the interest on these kinds of loans upfront. Interest will be collected upfront. Okay, so that upfront collection of interest will be for how many months? Let's say he is presenting the bill on 1st April, then it will be for a period of 3 months, because on the expiry of the 3rd month he is going to get the money from Mr. B. That is, the banker will be able to close the loan of Mr. A by collecting the money from Mr. B. So bank will collect the interest upfront for a period of 3 months, and only the balance will be given as a loan. So this upfront interest is called as discounting charges. Okay, this upfront interest is called as discounting charges. So like this, various other aspects are involved. Let us understand one by one in the subsequent sessions.